now within the AI space. So let's talk about AI. Let's talk about what it means for investing. I know we've talked about AI a lot lately, but it is the thing driving the markets. And I think it is the thing that the investor, you and I, we need to talk about so that we know what to think and how to respond to AI. Good morning and welcome to Life in the Markets. Today is November 3rd, 2025, and my name is Tim Russell. We have had another roller coaster of a week. It's been a choppy week for the markets. Most of this is because traders are trying to digest what the Fed has done in relation to interest rates and the overall comments about future rate cuts or maybe the lack thereof. So all of that being said, what we've seen is that the S&P 500 was down slightly from where it started the week. It's down about 0.2%. The NASDAQ was up just a little bit more than 0.5%. The Russell was down the most. It was down 1.7% of the major indices. We look at some of the materials. Gold was off 1%, silver's up 1%, oil was down just shy of 1.5%. So we've got a lot of choppiness going on even in some of the materials that we tend to cover. Bitcoin was off actually about 6%. So another more difficult week there in that area of the economy. Bonds. This is another interesting one. Now, bonds actually had a bit of a rough week. I'm going to get into why that's a little interesting in a moment, but the 10-year Treasury ended up dipping down below 4%, but ended up about 4.7, almost 4.8% here as we start the week. So that's just actually for bonds, for the 10-year Treasury, that's a meaningful move. If the 10-year Treasury is moving that much, there's certainly some amount of concern going on. If you really want to know what's going on in the markets and what's going on with risk, you should probably pay closer attention to the bond market than we even do the stock market. What does that tell us? I think what that tells us is that if interest rates are increasing on the 10-year Treasury, there is some concern about overall risk with the economy. We're seeing little ripple effects of risk concerns showing up in earnings reports and other things that we're seeing throughout the week. The big news this week, however, was the Federal Reserve. The Federal Reserve on Wednesday announced that they were going to lower the interest rates by 0.25%. Now, this was largely expected. You'll go back to last week's episode. We said, yes, they highly anticipated that they're going to cut rates. So it was no one's surprise that they did. But here's what did surprise many traders. What the Fed then went on to say was that, hey, guys, pump the brakes. It's not a foregone conclusion that we're going to have another 0.5% rate cut in December. That's important. That's meaningful because what that tells us is that, well, the Fed doesn't have quite the confidence level that they need to cut rates again, or maybe they just don't have the data because of the government shutdown that they would want to have to be able to determine whether we're going to have a rate cut. All of that being said, if you fast or rewind to last week, we showed you a chart that indicated probability of a rate cut in the December Fed meeting was like 98% probability of a rate cut. As of today, it's 69%. So we have seen a 30% chance of no rate cuts coming up in December, and it was that right there that caused the market to say, hold on, we're pricing in lower interest rates. Maybe lower interest rates are not on the table. A couple things I want you to know about this. The first thing is, when I say that there's a certain percent probability, it is at a particular point in time, and those probabilities can change and can change wildly and rapidly. And it just takes one Federal Reserve comment where now all the prognosticators are saying, well, maybe I need to revisit my expectations. So always take news-related pundits giving you certainty of some potential outcome with a grain of salt. Even me, if I say that we're going to have a 69% probability of a rate cut, take that with a grain of salt. Everything is fact-dependent, and nothing in the probabilities guarantees that it's actually going to work out the way anyone expects. Another thing I think that means is that we don't have a lot of data. The government's been shut down now. This is our fourth week for a government shutdown. It's the longest shutdown I think we've ever had. And politics aside, one of the things a government shutdown means is that we don't get some of the reports, the economic reports that many of us rely on to kind of know where we are within the broader market. So what that means is that we have to pay closer attention to earnings reports. And as I mentioned a couple weeks ago, we're coming into earnings season. And this week we had a flurry of earnings reports, and many of them from the big players out there. So all of the major tech companies, your Apples, your Alphabet, that's Google, Amazon, Microsoft, and many others, they released their earnings reports, and they were almost universally very strong earnings reports. These companies are making money hand over fist. They're super excited about AI. They're the strongest investors in the AI space and in the AI growth. So they're huge believers in AI. And we're seeing that that's definitely a positive thing. We're also seeing that from the Visa lenders, like Visa, MasterCard, things like that, they're showing a steady increase in spending. There doesn't seem to be any stress on the consumer with regard to paying their credit card bills. Maybe that's a good thing. Maybe that's also not a good thing, because if we're putting more on credit cards and carrying more of a balance, what that may indicate is that the consumer doesn't have enough discretionary cash to cover their traditional expenses. So we have an increase in credit card borrowing as we're trying to get through the inflationary environment that we're in. That being said, inflation here in America, we're at 3%. We talked about that again the last couple of weeks. 3% is a relatively good number in spite of the fact it's up a little bit. It was actually up a little less than what they were expecting. 3%, frankly speaking, not as bad as maybe some would fear. Okay, so this leads me to, I think, the bulk of what I want to talk to you about today, and that has to do with AI. Look, what is really interesting right now is that we're having a divergence in the market. We're seeing that the AI aggregators, those are the big tech companies I referenced earlier, the Googles, the Microsoft, Apple, Amazon, all of these companies are doing really well, hitting new highs. It's an exciting time for the big companies. But what we're seeing is that medium to smaller size companies are not doing that well. The number of companies hitting the 52-week low is actually the highest level it's been since March of this year, which is interesting because we're just a couple percent off of the all-time highs in the stock market. What that tells us is that the big companies driving the markets are up well, and the companies that are smaller to medium size are not quite doing as well. That is of note to me. And another thing that is telling me is that there's way too much excitement right now within the AI space. So let's talk about AI. Let's talk about what it means for investing. I know we've talked about AI a lot lately, but it is the thing driving the markets. And I think it is the thing that the investor, you and I, we need to talk about so that we know what to think and how to respond to AI. Now, there are AI doomsayers who say this is entirely a bubble. This thing is going to pop. There's no way AI can deliver all of the promises that it has given. Therefore, be prepared. This thing is going to pop and it's not going to be pretty. There's a chance of that. I have to admit, there's a chance of that. I don't know that it's a huge chance, and it's not entirely analogous. The situation's not analogous to the dot-com bubble back in the late 90s, early 2000s. But it is bubble-ish, and it has some similarities, but a lot of dissimilarities. We can talk about that maybe at a different time. What we are seeing, however, is that AI, a lot of people are expecting AI is going to go to the moon. It's going to change the economy. It's going to change the landscape of employment. It's going to change the profit margins of all of these companies. And if we don't invest in AI, we'll be disrupted by AI. So you better be a disruptor or you'll be disrupted. So that's why your Apples and Alphabets and all of the rest are investing billions upon billions of dollars into AI so they can be the disruptors and not be disrupted by a new upstart organization. Here's the problem. I think from a theological perspective, many of my conservative friends and biblically minded people think about AI maybe the way that some might think about the end of the world. It is somehow analogous to overthrowing the dominion of mankind, and it's the beginning of the end, and it's the beginning of what God's going to do to bring about the return of God and the rapture and all of those other things. And without getting into the theological nitty-gritty of eschatology, I do want to talk about the reality that my baseline assumption about AI is that AI is a good thing. I know some of you don't like that, but it is a good thing. AI in and of itself has some strong potential to be beneficial to mankind. However, on the flip side of that, AI is not able to replace mankind because we are uniquely created beings. We were created by God with the image of God implanted on us, which means we are unique in the entire created order, and there is absolutely nothing that mankind can make that the creation, mankind, we are created, we can't make something better than us. We can't do it. AI can never replace humans. It can help humans. It can help advance technology. It can help advance our research and understanding, but it's going to accentuate the positives of what mankind can do. But you also have to recognize AI is not necessarily a purely good thing. It is more like a neutral thing that good men can use for good purposes or that evil men can use for evil purposes. It's like any kind of technology. So where are we in terms of the investment landscape with AI? My attitude is we need to see it grow. We need to see it come to fruition. I think we are too early in this game to start picking winners and losers and to start getting overly excited about it. I really do think while there is bubble-like tendencies going on, there still is some profit that's happening from it. I just think that the power demands that AI needs is way outstripping what we're able to generate. So my wildly irresponsible prediction is that I wouldn't be surprised with the next 5 years if the growth of AI and the demands on our power grid continue on the projected path without the associated increase in power generation capacity. We're going to see two things happen. Number one, our energy prices will increase sharply. Electric costs will go up because it's entirely subject to supply and demand. Number two is while prices are going up, quality of the reliability of the service will go down. I would not be surprised at all to see more brownouts and other types of frustrating power grid stability here in America because the demand of the electric draw is so high. Now, that would all be true if there are not innovations in the power management and the power efficiency of these chips and the processing. I think that right there is one of the huge untapped potentials. If we can find a way of doing AI with these chips with a lower energy footprint, I think the sky's the limit with some of the great things that could be done within AI. Some of the promises that AI is writing, some, not all, could come true. But on the other hand, if we don't have efficiencies built into these chips, and we don't have capacity built onto our energy system. Again, we're getting too excited about AI, and I don't expect AI is going to be the kind of growth engine in the future, the next 5 years, that perhaps it could be if we had those things solved. So that's my baseline assumption. I'm not going to worry. I'm not an AI doomsayer because I believe in God. God created the best thing, and that's mankind. We are in the image of God. Therefore, I'm not worried that AI is going to replace you or me. I'm not worried that AI is going to replace all jobs and make us all unemployed, because it takes humans to know how to use something like AI and to use it well. With that being said, I hope that's an encouraging summary for you thinking about AI and trying to be realistic about what we can reasonably expect AI to do with us and for us. Let me give you a verse of the week here as we wrap up our time. And I think this one comes from James chapter 4, verse 5. I love the book of James. It's such a neat book. But it says this: "Behold, the wages of the laborers, which you kept back by fraud, are crying out against you." This is a warning to the rich landowner who is so worried about growing their own wealth, they're willing to abuse others to get more wealth or to keep the wealth that they have. We do not get wealth through fraud, manipulation, and corruption. In fact, one of the things that this passage says to these rich individuals is that the wealth that you kept back, it's going to be used against you in the day of judgment. It's actually storing up for you wrath to come. So, brothers and sisters, as investors, we are not manipulators. We're not trying to take advantage of people. We want to do what God has called us to do in this world and care for people, because investing is about the flourishing of mankind. And you can't expect the flourishing of mankind while you hold back rightly earned wages for individuals. So that's my thought for us today. I hope you have an absolutely fantastic week. Enjoy the fall. Take care. Be safe in the markets.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management. Member FINRA and SIPC.